We are looking at futures pointed down, but we're 20 points away from an all-time high. So if that turns around, it would be very interesting. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, bracing for September swings. Investors are looking to key economic data this week for clues on the Fed's rate path.
And U.S. steel falls. Kamala Harris joins Joe Biden in saying the company should remain domestically owned and operated.
Plus, Citadel and Jane Street on track for record revenue hauls as they further encroach on the big banks. We're going to get into all of that, but let's take a look at where markets are trading 30 minutes until the bells ring. You can see it's not too pretty pre-market on this first trading day of September. Of course, we had a big finish to Friday and to August, not reflected in what you see right now. The S&P 500 down about 0.6% pre-market, a little bit more so if you take a look at the NASDAQ 100. A little bit of a rally building in the bond market all the while. The 10-year Treasury yield currently down about 2 basis points, Matt.
Yeah, it looks like traders could be worried about the ISM PMIs coming out today. Here's a look at what we've seen in terms of the PMIs. Manufacturing is in white and services is in blue. Services has been coming back, manufacturing on its way down. We expect a little bit of a bounce today, but if there's a disappointment, it could mean you see more red arrows on equities.
There are certainly traders riding on that, but there's also some stocks to watch before the market opens. Traders are riding on U.S. steel lower. It is slumping after Kamala Harris now joins Joe Biden and Donald Trump, saying that it should remain American-owned. Japan's Nippon Steel is eyeing to take over the company, and you have U.S. Steel now lessening its losses on the morning, but still down 3.7% pre-market. Boeing also dropping after being downgraded by Wells Fargo from equal weight to underweight. It got a street low price target of $119, which implies a 32% drop from Friday's close, Matt.
Yeah, a lot of calls today. Actually, B of A and Wells Fargo both downgraded at Deutsche Bank, raised at Deutsche Bank. JP Morgan was downgraded there. Really, it's all about September. A lot has been said about this being the worst month for equities historically. This chart shows that.
Chart, as you
what
can see.
What a beautiful chart. So it's been a tough month for stocks historically, and now that we're all at all-time highs, Katie, I feel like there's a lot of room for investors to take profit.
Yeah, big time. And I'll note that that's a world chart, too. That's MSCI World Index. So it's not just the U.S. where you see this phenomenon. But you think about this specific September, and there's a lot of known unknowns. Just this week alone, you think about the triple whammy that we're going to get when it comes to the U.S. labor market. We have JOLTS, we have jobless claims, and we have the jobs report.
We sure do, and you also have to think about the positioning even headed into those reports. It was actually hedge funds that led a lot of that net selling last week of August. But you have to remember that manager at T. Rowe that called the yen really spiking and shocking the market here sees another leg to come. You have to wonder if that carry trade or other leveraged positions like that can see more unwinds as we see this volatility, guys.
Yeah, absolutely. And we have the yen rising up again today. Right now, you can only buy 145 yen for a U.S. dollar. Jim Caron, CIO of the Portfolio Solutions Group at Morgan Stanley Investment Management, joins us now. So, Jim, there's the setup. It could be a tough month. Is it best just to take your profits and hide out through September?
Well, good morning. And let me also point out on that chart you just showed is that after September, November is one of the strongest months if you look back at a seasonal period. So to answer your question directly, yes, I think it is time to take profits. And that's exactly what we are doing within Morgan Stanley Investment Management in the Portfolio Solutions Group, is that we had been overweight. We got overweight in the weakness in early August, and we took those positions off. Not because we're turning bearish. I want to be very clear about this. Not because we're turning bearish, but because it's a strategy for us to buy weakness. We still think that we are in a structurally positive market, and that if we get some weakness, that it's going to be an opportunity to buy. So therefore, we want to be able to keep our powder dry. So if we have an event like in September where you do get lower prices, then we're in a very comfortable position to then make it up and really try to press it into the end of the year going into October and especially that November positive seasonal period.
So keeping your powder dry, buy on weakness. Let's get specific here, though. When you're talking about weakness that you would potentially act upon, are we talking just a blanket recommendation there? Are you looking at specific segments of the market here?
Yeah, that's a really good question. I mean, so the way that we think about this is we're still going to be led by growth in tech, if you ask me, right? So if there's weakness in the market, it's more likely to come in the large cap, particularly the tech sector. That's just the highest part of the index, right? So if you get weakness, that's generally what starts to get hit the hardest. So therefore, I also would think that that actually starts to recover the best. However, what we are starting to realize and we're starting to observe is that there has been a broadening of the market. So there's great opportunities to buy the real estate sector, to buy materials, to buy energy. These are all great sectors too, even to start to look at industrials, healthcare. So it is somewhat of a blanket statement, but if you really want to press it, I think that you're going to probably buy the stuff that went down the hardest, and that if there is a correction, then I would argue that it would likely come from the tech side.
Jim, when you think about the week ahead, of course, there's a lot of economic data, starting with just about an hour from now with that ISM data. And if you look at the Bloomberg economic projections here, the panel that Bloomberg reads from all economists here, or a subset of one at least, almost all of them are projecting a rebound here from a poor reading last month. At the same time, you see the labor market starting to weaken. How do you read the macro into your investment decisions at this point, given that there's such divergence in views?
Yeah, this is where there's some inconsistency, I think, in the risk skew that's in the markets right now. Because I think that the equity markets today are asymmetrically skewed to the downside, at least over the near term at these current price levels. Let me explain that. If we get a payroll number, that's the number everybody's going to really focus on this week, that comes out to be weaker. Consensus is somewhere around 165,000 jobs, 4.2% unemployment rate. If that comes out even a touch weaker, I think that equities can move disproportionately down more than they can actually move up. So I think the market is going to really focus on the bad news right now. So bad news is really bad news. And that is probably what creates the correction that I think is going to occur in September. That's also true with ISMs. It's also true with, if we want to look at jobless claims, the JOLTS data, all of these other data series that are coming out in the near term. I think there's an asymmetry in risk for equities to see this as more negative. We also have to recognize that the valuations, I mean, we're trading on right now, 2025, about 14% earnings per share growth over 2024. The market is priced to, I'd say, close to perfection, and in a reasonable risk range. I'd say 5,200 to 5,650 is my range. I think we're at the top of that range for right now, unless we get new information.
Well, we saw that with NVIDIA, Jim, right? I mean, they beat, and yet I think on the day they were down 6.5%. I was in Spain on the beach reading my Bloomberg. But is that going to be more of a problem for those big mega cap tech stocks? I mean, are the, what do we call them, Magnificent Seven stocks going to take a bigger hit on bad news? Will you see a rotation into the stocks that haven't gained as much ground?
Yes, I think that's exactly it. I mean, look, the news on NVIDIA wasn't terrible, right? It's just about future earnings and how are they going to keep pace. I think the markets from a macro perspective are in a period of normalization. If I just look at the macro fundamentals, unemployment is slowing. If you have, growth is supposed to slow. This is what's supposed to happen when the Fed hikes rates as much as they did. And what that also translates into is a normalization in the growth rate of earnings of these mega stock tech companies that are out there. The market doesn't like that. The market wants to be surprised to the upside every single earnings report. And I think that just dialing that back, even to a more normal run rate, which is what I think NVIDIA did, is viewed as a disappointment. So that's why I'm saying that there's an asymmetry in the risk profile that's in the market, where the market is going to react more to even slightly negative news than it will act to slightly positive news. And that's what makes us defensive right now And that's why we've dialed back our risk in our portfolios after taking it up in early August.
Well, to be fair, we didn't just see that dynamic play out with just NVIDIA. It happened with Abercrombie and Fitch as well. I mean, great numbers, really brutal reaction in the stock, at least on that specific day that they reported. So really an interesting juncture that we're at when it comes to market sentiment and how earnings are being treated. But I want to go into the specifics of your views right now. You mentioned that you've moderated when it comes to U.S. equities. You've shifted to that neutral stance when it comes to the U.S. Then I take a look at your European call, and you have an overweight to European equities. So talk us through that. Of course, the U.S., a little bit neutral here, but then you take a look overseas, and it seems like you're a bit more positive there.
Yeah, so I think in this stage right now, with the ECB likely to cut interest rates, and most of our overweight in Europe is based on financials. And we think that sector has been undervalued. It has been doing very well, actually, more recently. But we still think that there's more room to run there. We think curves can steepen. We think that as inflation gets more contained in Europe, that I think that the financial sector can actually start to do a bit better. So that's primarily where we are there. And I think that the valuation, as we move from these high PE sectors like tech and things like that, other sectors that are a bit more value orientated, and that's Europe. Europe is much more of a value equity market, start to get a little bit more of a shine towards them. And that's why we've moved there. And the other place that we're still positive on is Japan, Japanese equities. I know we're talking about dollar yen. We were talking about it earlier in the show. And I think it's likely to be in a range, and dollar yen may even weaken a little bit. But I think that Japan is in a secular bull market. They finally have inflation. They're going to get nominal growth, which is nominal GDP, nominal earnings, and that tends to boost equity prices. And I also think that globally, we're going to be moving into a very large CapEx cycle over the very long term, which is going to significantly favor the Japanese economy and the Japanese equity markets as a result.
Jim, as we've been speaking, you've seen Brent crude drop below $75, erasing gains for all of this year. The energy sector was something that really propped up the stock market in the last couple of years. And you also have copper, very volatile, sending kind of signals under the market that perhaps things are really slowing. A lot of that coming from China. But of course, a bellwether here on how bad things can really get. Do you think that these commodities are telling us a story that other markets are not really screaming right now?
Yeah, there's a lot of inconsistencies, and we are slowing. And this is part of the point here, is that I view this as a normalization. And when you look at things like copper, when you look at commodities like oil, these things tend to be hyper cyclical. So if there's any slowdown that's occurring today, or we think is going to occur today, the biggest impact you're going to get is in those futures contracts, in the metals, and in energy. So I think that's what the market is pricing in, is that we are going into a slowing period. I mean, make no mistake about it. And that's why I'm a little skeptical on today's current level of U.S. equities, is because we're priced to have 14% earnings growth going into next year. And I'm not seeing a big global cyclical recovery based on copper, based on oil, or anything else like that. It doesn't mean that we're going to have a bad year. It just maybe we have 10% growth in earnings. But the point, though, is that we probably do need to take a bit of a breather from current levels where we are today.
Jim, we thank you so much for your time. That is Jim Caron, CIO of Portfolio Solutions Group at Morgan Stanley Investment Management. Thank you for taking us across your views in a complicated market to start a tough September, what is traditionally a down September. We're going to check on futures because we are starting this down September on a down day. We have 6/10 now, 1% lower on the S&P pre-market. NASDAQ 100 futures down 0.7%, and Russell 2000 futures down 1%. Remember, this started August as the favorite trade. You are seeing the views changing before your eyes. Flip up the board here. Look at commodities as well. We're going to take a look here at Brent, WTI, and gas, because amazingly, Brent is erasing its gains for all of this year. And you really do have movement today alone. Brent crude now down 3.7%, below a 75 handle. New York crude at 3.2% lower at 71. Natural gas futures trading about 0.2% lower. Now, coming up, presidential candidates throw cold water on Nippon Steel's plan to take over U.S. Steel. This has been a long time coming, but of course, yet another candidate seeking to squash the deal. Details next. This is Bloomberg.
Getting out of high interest to look at what's making headlines around the world. President Biden tells reporters he plans to speak to Israeli Prime Minister Benjamin Netanyahu, quote, eventually. Over the weekend, the Washington Post reported that the U.S. plans to present a take-it-or-leave-it ceasefire deal to all parties soon. Biden's remarks came after 6 Israeli hostages were found executed in a Gaza tunnel, sparking protests in Israel over the lack of a ceasefire deal. And the U.S. is laying the groundwork for new sanctions on key Venezuelan officials following Nicolas Maduro's disputed election win in July. The Treasury Department is close to announcing 15 individual sanctions, while the State Department plans to impose visa restrictions on 34 relatives of government officials. Vice President Kamala Harris is moving $24.5 million down ballot to help candidates in races for the Senate, the House, and state legislatures. Harris's campaign said that she believes the race is about mobilizing the entire country. Harris has raised over $500 million since President Biden withdrew from the race. Katie?
Well, sticking with politics, let's check in on shares of U.S. Steels under pressure this morning, currently down about 3.5%. That was 7% earlier in the pre-market session. And the focus here is that Nippon Steel's plans to take over the company being squashed. This is what Kamala Harris had to say about it yesterday.
U.S. Steel is an historic American company, and it is vital for our nation to maintain strong American steel companies. And I couldn't agree more with President Biden. U.S. Steel should remain American-owned and American-operated.
And Simon Casey, he is a Bloomberg managing editor for energy and commodities. He joins us now. And Simon, in a lot of ways, this shouldn't be a surprise. I know there was hope that Kamala Harris would sort of reverse course here and take a divergence from President Biden's stance, but not the case.
Well, no, I mean, so far on a whole host of issues, we're still waiting for Harris to come out and state her position on a variety of policies. So this is the first time that she's talked publicly about U.S. Steel. And yes, you're right. It's not really a surprise. She's hewed very close to the line that Biden's taken so far. And of course, Trump has come out and J.D. Vance has come out and said U.S. Steel should remain in American hands.
The politics here are so clear, but what about the reality, Simon? If they are not acquired by Nippon, what is the fate of U.S. Steel, especially because the really field of potential U.S. buyers are gone? Is that fair to say?
I think that is fair to say. I think, as well as you know, if you remember from earlier this year, Cliffs, the biggest rival to U.S. Steel, put in a bid. It's kind of pulled back. It's going its own way now. If Nippon Steel is unsuccessful, it's blocked. In fact, if there's a CFIUS review at the moment, if the CFIUS review comes through and says, we recommend the president blocks this deal, who else can come in? There's a vanishingly small sort of number of foreign players, and it's tough out there in the steel industry. It's been tough for decades.
Why would they want it anyway, Simon? I mean, if U.S. Steel can't do well producing steel in America, why would Japan want to buy U.S. Steel and do poorly producing steel in America?
It's a very good question. If you remember when the bid came, when the deal was announced, it took us all by surprise. No one really saw this coming. But the rationale, as it is Nippon Steel does see demand for U.S. steel if infrastructure spending keeps on increasing under the current incentives under the Biden administration has passed. Also, in a future, well, its reality is it's happening right now. In effect, tariffs are increasing in a very high tariff world, a world where we see a lot of trade tensions. These walls go up. U.S. Steel does have a certain amount of defense from imported steel. But U.S. Steel is a relatively small player in the world. I think something like the 24th largest steel producer in the world. It's a minnow. Nippon Steel is number 4. So it has commensurately the larger balance sheet, the more investment, the technology it can bring to bear. And in fact, Nippon Steel came out last week with an announcement that said post-merger, assuming this merger goes through, we're going to commit an extra, I think it was $1.3 billion of investment. So that's what they're pledging to put into place if this deal goes through.
30 seconds here, but is this a matter of just rhetoric here? Because we have seen Japanese companies own U.S. companies. We're talking about 7-Eleven, once based in Texas, now owned by a Japanese company. No one seemed to have a problem there. Why is this one a bigger issue?
It's touched a real nerve. It's in Pennsylvania. That's where Harris was speaking yesterday. So it's the swing state, arguably. The Steelworkers Union, a very powerful, very historic union, has come out clearly said we are against this deal. And so, it's very difficult, really, for either party to come out and sort of deviate from the line that they're both taking at the moment.
Simon, we thank you so very much for your time. This is very much a matter of politics at this point and very unclear future for this company ahead. Coming up, we're going to switch gears. We're going to take a look at companies making the most buzz today, including the return of a little band from Manchester and anger at ticket sellers. Social climbers up next. This is Bloomberg.
Moments away from the start of trading, the first day of a shortened week, the first day of a month people say is the worst for stocks, and we do see futures down. S&P futures off 0.6%, a drop of 0.75% on NASDAQ 100 futures. There you hear the opening bell on the New York Stock Exchange, as well as down at the NASDAQ marketplace. Now, I was looking at an average over the last 29 years, and September was off in that average about 0.2%, making it barely the worst month of the year. This month could be different, of course, but we're at almost all-time highs on stocks, Katie, and we have a ton of economic data that people are going to be watching super closely. ISM today, you've got JOLTS tomorrow, jobless claims on Thursday, NFP on Friday. So a lot could happen this week. What are we looking at right now as the averages kick off?
A lot could happen, to your point. We get a ton of labor market data this week, but at least for right now, what's happening is a downdraft. When you take a look at the U.S. stock market, the S&P 500 currently off about 0.6% in the pre-market. Big tech, a little bit more here, of course, 0.8%. There's been a lot of questioning over big tech's leadership in this market. Of course, we'll have to see how the rest of the day goes. Then you take a look at the small caps, your Russell 2000 index, of course, the sort of north star of a lot of consternation over leadership. Right now, it's your biggest loser, down about 0.9%. But let's get to some single stock action right now. And we have to start with U.S. Steel, because Kamala Harris says just yesterday that the company should remain domestically owned and operating, challenging Nippon Steel's proposed takeover. Remember, Trump and Biden have similar stances on the deal. There had been some optimism that maybe Kamala Harris would take a different tack. Not the case. You take a look at shares right now, Sonali, down 5%.
Katie, it's incredible. The commodities trade really driving the equities trade today, because I'm also looking at Freeport-McMoRan. Goldman Sachs has exited its long-term bullish position on copper, citing weakness in China. Goldman's price forecast for 2025 is now $5,000 lower, and you have Freeport-McMoRan really plunging here in conjunction. You have it down almost 5% lower this morning, really 4.8% as the morning opens, Matt.
All right, Boeing was downgraded by Wells Fargo, giving it the lowest price target on the street. And Airbus, its only rival, is having some problems as well. Bloomberg's Abigail Doolittle has the details on these two big plane makers. Abigail?
Yeah, not surprisingly, both of these shares are down on these respective pieces of news. And I would say that Airbus may be down a little bit in sympathy with Boeing on the broader downgrade from Wells Fargo on Boeing relative to the company's free cash flow position and the possibility that it may peak in 2027. Analyst Matthew Aker seeing the cash opportunity out the door. Airbus, though, the news that you're talking about there, Cathay Pacific Airlines, they have found many issues. I think a third of their planes that they would fly with the fuel line. So they have actually grounded multiple flights. Those shares down 1%, Boeing down 4.1%. For Boeing, the problems are so many that this is just the worst day in a couple of weeks. It's not even that big of a drop. Let's take a look at that free cash flow that I was talking about, though, because for Airbus, it's not an issue. If we take a look at free cash flow in white for Airbus and in blue here for Boeing, Boeing has essentially burned through about $7 $7 billion in free cash flow this year. Our Airbus, on the other hand, is expanding. Not surprisingly, given this gap, in the numbers and all of the headline risk, the perception risk with Boeing. Well, Boeing is really suffering from a performance standpoint. If we compare it to both of the S&P 500 and an airline production index, we are going to see a bit of a decline here, some underperformance for the shares of Boeing, which since its 2019 peak, Sonali, down more than 60%.
Abby, thank you so much for those movers. Joining us now to broaden out the conversation is Tracie McMillion, Wells Fargo Investment Institute Head of Global Asset Allocation Strategy. And it's interesting, you see a lot of individual movers under the surface. We have been seeing this become more and more so a stock pickers market. But more so lately, you've also seen many investors start to think about this in terms of sectors. Where are certain sectors really starting to feel that weakness in the economy? Where do you start taking chips off the table, Tracie?
Yes, good morning, and thank you. So we think that the areas to be most cautious of are areas like consumer staples, REITs, and utilities. So those are the sectors where we think that the higher interest rates will continue to play a role in investors viewing those sectors as the weaker components of the market. So instead of those sectors, we would focus our attention on things like communication services, cyclical sectors like energy, industrials, materials. We also like financials.
And it's interesting, Tracie, because I'm taking a look at your notes, and you make the point that investors shouldn't get hung up on 25 versus 50 basis points in September. That's splitting hairs, that we know that a series of interest rate cuts are coming from the Federal Reserve. But even so, I mean, piecing together what you're saying here, it sounds like that's not going to be enough to help the parts of the market that really need big rate cuts.
That is true. Yes, at least not initially. And at this point, we do expect 100 basis points in cuts through the end of the year. Whether we get 50 in September or 50 in November or December, we don't think that matters as much as the fact that the Fed is starting its rate cutting phase. And as we move into 2025, we expect another 75 basis points. And we think that all of that combined will start to help, especially the cyclical sectors, areas of the market that have been really beaten down during this period of high rates. As rates start to fall, we think things like small caps are also going to benefit.
I mean, it seems like it'll be helpful to the stock market, but I'm not sure about the underlying economy. There was a great piece in the New York Times this weekend by Gina Smilek pointing out that the housing market, for example, needs a lot more than rate cuts. The problem is high labor costs, high material costs. I'm thinking for the auto industry, it's the same problem. Aren't there some of these, cyclical, some of these industries that, need more government policy changes than rate cuts to help growth?
That is possible in certain sectors like housing in particular. That is an area where we often do see fiscal policy stepping in to assist homeowners, home buyers, to assist builders. So it's possible that could be one of the factors. But really what we're seeing when rates do start to tick down is that more buyers are stepping into the markets. And really the issue with the housing market as we see it is more one of supply and lack of turnover. So, lower rates are really going to start to loosen up the housing market, and that could be another positive component for the economy as a whole in 2025.
Tracie, I'd love to talk a little bit about what's been popular in the market lately, because even though you have seen that worry about where valuations are in the broader S&P 500, worries about where those high flyers really stand, after we've seen such a run-up this year, you've actually had the S&P equal weighted post 5 records in August. Why are there no valuation concerns there if you believe the economy is going to slow down?
Yeah, so what we see in terms of the macro, let's just start there, is more of a saucer-shaped growth pattern through the end of this year. So, the economy's starting to slow, not dip into recession, and then starting to gradually improve in 2025. So in that type of environment, we do think that cyclical assets, cyclical sectors could benefit and broaden out the positive returns that we've seen in the market so far this year.
And Tracie, it feels like one of the themes, at least of this morning, is known unknowns. When it comes to this week, of course, all the data events this month, and then looking over the course of the year, obviously we are just several months away from the U.S. election. How much of a downside risk is that for investors? How much does a long-term investor really need to be thinking about what happens in early November?
Yeah, so long-term investors don't really need to be focused on the day-to-day or the month-to-month choppiness that we see in markets. In fact, if you're dollar cost averaging in, that choppiness, those downturns are great opportunities to invest for the long term. But most investors are thinking about the nearer term, and they're thinking about the potential for some volatility around the elections. As we move into September, October, in an election year, that does tend to be a period of greater uncertainty because some unanswered questions start to come into view. Questions about fiscal policy, questions about trade policy, what's the likely path towards resolution of the debt ceiling in the first part of 2025. So all those things are going to start to play into the investor psyche as we move through these fall months.
All right, Tracie, always great to get your perspectives. Really appreciate you taking the time. That, of course, is Tracie McMillion of Wells Fargo Investment Institute. Now, coming up, Goldman Sachs abandons its bullish bet on copper. Details next. This is Bloomberg.
This is Bloomberg Open Interest. Quick check on stocks this morning. We are looking at a down day, the first trading day of September, the first trading day of a shortened week in which we have a lot of economic data due. Today, in just about 17 minutes, we're going to get ISM manufacturing and PMIs, and it looks like that could really move the market. Take a look at the energy prices here, because we did have Brent crude, not NYMEX, Brent crude fall below $75 a barrel. So the global benchmark trading at $74.44. NYMEX crude down now below $71 a barrel. And copper, after a Goldman call, falling more than 2% on concern about less demand out of China. Katie?
And we'll get into that copper call in just a minute, but it's time now for our top calls. Some of the analyst action in focus this morning, and first up, Benchmark is downgrading Sphere Entertainment to sell. Analyst Mike Hickey expressing concern on the scalability of the Sphere, as well as its high production costs and a potentially underwhelming profitability outlook. Next up, we have Morgan Stanley cutting Apple's Alphabet's price target to $190 from $205. Morgan Stanley citing uncertainty related to antitrust actions. And finally, Evercore raising Southwest to outperform. The firm citing the, quote, long-awaited transition to capacity discipline, new revenue initiatives to be outlined at the company's upcoming Investor Day on September 26th, as well as strong underlying fleet value. Sonali.
And checking back in on shares of Freeport-McMoRan. The miner lowered today after Goldman Sachs slashed its price forecast for copper by almost $5,000. Goldman cited shrinking demand in China, but of course you see broader ramifications. Bloomberg Intelligence senior commodity strategist Mike McMillion joins us now. And if you think about Goldman's call here after years of bullishness, how drastic is it and how global is it in nature, given that the demand issues are really spurring from China, but impacting really now companies around the world?
They, I think, are just pointing out the obvious, and a lot of copper traders have figured out a little while ago. And I think copper is just following what you're seeing happening in China. The data this weekend was horrible, but it's been the trend. The question is what stops that trend. PMIs are weaker, the housing market's a problem. Every day I type on the Bloomberg terminal BI, China and anti-China. It kicks into my macro theme that China is just a rapidly advancing emerging market that's reverting, and copper's right in there. So you mentioned copper. People look at it in tons. I like it in the per pound price because you can overlay it with bond yields, and it tells you where things are going. So right now, the 10-year note yield in China, the CGB, is 2.15%. The 10-year note yield in the U.S. is 3.85%. And copper's bouncing on $4 support. On the same scale, copper should probably go to 3.
You know, it's not just China, right? We don't have a lot of housing starts here in the U.S. as well, Mike. And one of the concerns is materials costs. Now, if these costs come down, does that mean we can start, building more housing stock in the U.S.?
Oh, yes. All the costs are going down. Lumber's collapsed. Crude oil's collapsed from its peak. Corn has collapsed 50% from its peak. It's normally what happens in commodities. It's the number one force in commodities, Matt, is they go down because they went up too much, and now they're on the track going down. The question is where they stop. And we see what's happening in the stock market. The stock market basically has to stay up for these things not to continue lower. So I think we're in the process right now of seeking out those low price cures. Copper's a little different because it's global macro, and China's in decline. But if you look at all the other commodities, crude oil's probably heading towards $40 a barrel. It's not profound. It's what it's done since 2008 to make lows. Natural gas has already done it in the U.S. It dropped below its cost of production. So the question is, how do we stop this? And basically, you need the Fed to cut really fast and soon and the stock market to stay up. Otherwise, the commodities can do what they normally do, get cheap.
Well, we know the Fed is going to cut soon, TBD when it comes to fast, but I want to compare and contrast copper to gold here, because the second part of Goldman's call was that basically gold is standing out as the commodity where they have the highest confidence in near-term upside, saying that that's the preferred hedge when it comes to geopolitical and financial risk. Does that argument hold water with you?
Oh, absolutely. And it's good to see them coming around to the view we pointed out a few years ago. But the key thing about gold is almost always outperforms all the other commodities, particularly copper. But now that gold-copper ratio should continue higher. So on a one-year basis, gold is up about 30%. It's beating the S&P 500. It's definitely beating copper. And the Bloomberg Commodity Index is down about 5%. That's a global recessionary trajectory from commodities. And I don't see what stops it. What's one of the biggest buyers of gold? It's been China. Why? Because China's heavily in decline, and we see that their investment options are declining.
Well, Mike, really appreciate your perspective. That is Mike McMillion of Bloomberg Intelligence joining us from Miami. And of course, later today, catch an interview with veteran commodities analyst Jeff Curry. That's at 3 p.m. Eastern on Bloomberg Markets. But coming up on Open Interest, record haul for two of the largest market-making firms in the U.S. More in today's Wall Street Beat next. This is Bloomberg.
And it's time now for the Wall Street Beat. Two of the largest market-making firms in the U.S., that's Citadel Securities and Jane Street, on track for record revenue hauls. And here with more is Bloomberg finance reporter Catherine Doherty. Record after record, really, for these guys. And they've made a lot of investments into new areas of trading. What's helping them catch up most with the big Wall Street giants?
So, number one thing, volumes. We saw the big U.S. banks when they reported their first half of the year. Everyone was up. For them, it was 18%. For Citadel and Jane Street, we're seeing a significant jump from a year ago. But I'll also say that last year was a pullback from the year prior. So you see ebbs and flows, but overall, across Wall Street, there's just record volumes that we're hitting, and we will be looking to see if the second half of the year is continuing this momentum. But from the looks of how we're starting today and going into the rest of, or to end 2024, it could be that they are notching another record compared to what would be 2022, which was their last records.
Now, by the way, what we're talking about is the money these hedge funds are making for themselves, right?
Market makers.
Market makers, not the hedge funds.
Or market makers. But so it's just the revenue that they're bringing in. It's not that, they're doing well in terms of portfolios.
They're not making any bets. They're basically facilitating the trades for institutional and retail investors that are looking to buy into securities, ETFs. For Citadel Securities, they've recently entered into corporate bond trading. For Jane Street, they had already been quite dominant in this space, and that's because they started out with their dominance in ETFs. They extended into fixed income. It was a natural expansion for them.
And of course, there's Citadel Securities, which is the market maker. And then you have Citadel, the hedge fund, which is making those big bets. And it's interesting, when you focus on Jane Street, we talk about Citadel all the time. Jane Street seems more secretive, but they did sell a $1.4 billion high-yield bond deal earlier this year, and I feel like that offered an interesting peek into maybe some of their financials, which we haven't really seen before. And it was interesting, I mean, how much of their business, how big and important they are when it comes to the ETF industry in particular.
Absolutely. They are the behemoth in that space. But what's also interesting is because they've been so dominant in ETFs, as I just mentioned, they were able to naturally expand to other asset classes. So they've become quite dominant in fixed income, in corporate bond trading, in portfolio trading within that space. So now it just will be the question of how do they continue this expansion? Is it global expansion? Are they going to look at other asset classes or fine-tune what they're already market making in?
And a fun fact, Citadel Securities had a new executive from Goldman just start days ago, Jim Esposito. So a lot of rumors out there about how soon they'll go public, right? I mean, this is an interesting time to be notching record highs, Katie.
That would certainly be something, definitely one to keep an eye on. That would keep Catherine Doherty to my left very busy. Great to see you, of course, on the first trading day of September. That is Catherine Doherty. Meanwhile, let's take a look at these markets right now. We are open and we are to the downside. You take a look at the markets, of course, the S&P 500 currently down about 1%. The NASDAQ 100 down 1.4% at the moment. So big tech is your big loser because you train your eyes on the Russell 2000 off by about 1% or so. Of course, this all feels very TBD until we start to get some of that economic data that we've been talking about. But I will say volume is back in a big way. On the S&P 500, Matt, currently we're 17% higher in terms of trading volume than the past average of the past 20-day average.
All right, very interesting fun fact there, Katie. Let's get to the trading diary. What you need to be watching this week. We get ISM manufacturing data at the top of the hour. So that's just 4 minutes from now. Tomorrow, we get earnings from Dick's Sporting Goods, Dollar Tree, and Couche-Tard. But probably more importantly, we get the JOLTS data, and less importantly, the Fed Beige Book. On Thursday, we have Broadcom earnings, but more importantly, and most importantly, you get the jobless claims on Thursday. And then on Friday, the big event of the labor market data, the U.S. jobs report comes out. So we get tomorrow, JOLTS, Thursday, jobless, and then Friday, jobs.
It's like a bunch of appetizers to just get us really excited for Friday's jobs report. It's a great question.
What dessert comes on the weekend?
The iPhone launch on Monday.
Coming up in the next hour, we have a delicious dish for you. Julian Emanuel joins us, Chief Equity Strategist at Evercore ISI. He thinks we can still get to his, I think, base case scenario, which is 6,000 on the S&P 500. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, investors are bracing for September swings. They're looking for key economic data this week for clues on the Fed's rate path ahead.
And shorts circle some of the AI boom's darlings, really question marks. We'll take stock of the winners and losers.
And as another year of summer travel comes to a close, we'll navigate the headwinds and tailwinds facing the industry with Brian Kelly of The Points Guy. All that and more coming up. But let's take a check on these markets about 30 minutes into the U.S. trading day. It's not pretty, which is fitting for the start of September, which, as we keep telling you, seasonally the worst month for the broader stock market. The S&P 500 currently down about 1%. More so, if you take a look at big tech, your NASDAQ 100 off by about 1.5%, totally forgetting that rally that we had on Friday. And a bit of a haven bid underway if you take a look at the bond market. 10-year Treasury yields currently down about 6 basis points. Let me correct myself. There you have it, Matt.
All right, it's confusing, right? Because it's in green.
I would never.
But it's down.
I would never refer to
when
a
an
bond
arrow
move
is
in
facing
percent.
down.
I know, but it's
the
a rally.
whole thing should be red.
Because price and yield.
I get it.
Reverse.
I get it. I get it. What are we?
Breaking ISM data.
Okay,
That's
ISM
why
data.
they're down, guys.
ISM data
That's why yields are dropping.
is a little bit disappointing. So we got manufacturing data crossing right at 10 o'clock, and it's a little bit less than had been anticipated, at least in our survey of economists, but it's still better than the prior reading. Let's get over to Bloomberg's Michael McKee with a look at the manufacturing picture in America. Michael?
That's a good read on it, Matt. 47.2 is what the number comes in for the month of August. For July, it was 46.8. So it is a slight improvement, but still below the expansion line of approximately 50. Prices paid is perhaps another concern, up to 54 from 52.9. Interestingly, among the commodities that they are saying is down in price, copper leads the list. So it fits with what you've been talking about this morning. Employment today is not above 50, but it does improve a little bit to 46 from 43.4. We'll get a view on that on Friday in manufacturing employment. Production 44.8 from 45.9. Not good. New orders down 44.6 from 47.4. So basically what it looks like is a status quo with the various indicators, because they haven't really changed all that much, been in the mid-40s to about 50 for almost a year now, and maybe close to 2 years. So not telling us that there's any significant improvement in manufacturing.
Well, when it comes to the U.S. August ISM manufacturing new orders, I mean, that is the lowest since May 2023. Not a fantastic size and scope, but still
over a year.
Something to note there. And you take a look at the bond market reaction. You have yields accelerating their drop because bonds are rallying, as we just told ourselves again. But how does this change the conversation around September? When it comes to 25 versus 50 basis points, Tracie McMillion told us not to split hairs, but we know that the market is, Mike.
Market's going to react to every little data point. We had a little bit of a reaction to the S&P PMI, which was a little bit lower than a tenth of a point lower than it was the prior month. And this is what we're going to get all week. You were talking just before the break about the various indicators that lead up to Friday. And what we're going to end up with is a lot of indicators that won't mean anything by themselves, but will get talked about in terms of, well, what does this mean for the jobs report Friday? And that's going to be the key to what the market really decides the Fed is going to do, that and CPI, unless there's some big surprise next week. So at this point, this doesn't change a whole lot. It's pretty much status quo, but we got a lot of data this week that will influence thinking about what happens on Friday.
Status quo, but still driving the bond market. Michael McKee, thank you so much for putting this all into perspective for us. And joining us now, we have the biggest bull on the street, Julian Emanuel of Evercore ISI. He sees the S&P 500 reaching 6,000 by the end of the year. But you look at data like today, and you still wonder, Julian, I have to ask you, despite being so bullish here relative to everyone else, is perhaps on a macro level the street being a little too bullish on what they're expecting out of economic data, given the negative surprises that we've had of late?
Well, this is part of the ongoing, and we're not saying permanent, but ongoing soft landing scenario, okay? If you look at manufacturing, it has essentially been, as Mike said, in this sort of weakened state for the better part of a year now. And, you know, part of the benefit of China not growing as expected has been the cap on commodity prices, which is a significant tailwind for risk assets in general to a point. But again, there is this expectation that this, you know, you're not going to tip over because of China weakness. And we've seen it in the past. And that's part of where the Fed's calculus comes into play. But for us, this is all part of the fact that the data is likely to be confusing as we go on, and also why we're underweight industrials.
Confusing but soft.
Yeah.
Right? I mean, so the data supports Fed cuts. That's good for the stock market and for your base case. Earnings have been really strong, stronger than expected, which is also good for stocks and good for your base case. I guess positioning is something you could argue about. Are we going to see a yen carry trade unwind again? But that seems to be a tempest in a teapot, if you will, because it sorts itself out after a few weeks. What are the risks to 6,000? I mean, what could bring us down? Because I imagine AI is a big one that stands out after NVIDIA's earnings.
So there's definitely the psychology around AI because, and again, we didn't expect, blowout to the upside, even though you got reasonably good earnings. But there is this ongoing question about, the use cases of AI and will that translate into further spend after sort of the hyperscaler CapEx really peaks at the end of next year. Our view is that you had some commentary this earnings season that really start to sort out the use cases. The world's largest physical retailer, for example, talking about their initiatives. You've seen it in other places. But the psychology, whenever you have valuations that are elevated, is going to be a bit more under pressure if the news flow isn't perfect.
Let's talk about some of that pressure. And when does investor patience run out with trying to figure out a use case? Because one of the narratives that emerged during this past earnings season was this frustration with how much a lot of these companies were spending on AI. That's great news, of course, when it comes to the likes of NVIDIA, for example. But then you think about some of the other big tech names really under pressure to basically deliver on what they've been spending. If we enter into next earnings season with that same frustration out there, I mean, do you think that we'd still be flirting with record highs, or is there going to be more frustration?
So going back to the discussion about earnings in general, the great thing about the second quarter was the other 493 stocks in the S&P 500 exhibited earnings growth for the first time in 5 quarters. That's really good. You're seeing that manifest itself in terms of broader participation. The advanced decline line may be esoteric for some, but for us, it continues making new highs, and that usually leads the indexes higher. But to your point, that is likely to keep these names range-bound for the time being. But again, the valuations are sort of nothing like we saw at the peak in 2000 when that bubble, which was clearly a bubble, unwound. And from our point of view, again, remember, we are only 2 years, not even 2 years, since the introduction of ChatGPT. This has legs.
But if you start to get some wobbles around the absolute faith in, of course, big tech and AI, even if you have the other 493 broadening out when it comes to earnings, is that enough to get you to 6,000?
We actually think it is. Look, if you have large-scale losses in those 7, that's another story entirely. The math of, the weight in the index certainly would be a headwind. But we don't anticipate that happening because a lot of what we saw, and going back to the yen carry trade in August, when you have volatility of that kind in the U.S. equity markets, it actually bodes very well on a 1-year forward basis for stocks.
Am I wrong to say it was a tempest in a teapot? Am I downplaying the yen carry trade?
I think you are. There are plenty of people that say that trade still exists and some worries out there. We'll see how choppy August was. You think about the marginal buyer here, and you have some strategists coming out and saying that in the last couple of months, really the marginal buyer was the retail trader. The marginal seller was definitely the hedge funds throughout the course of August. My question is, who's the buyer in this market? When are big institutions actually stepping in and making conviction trades?
Well, I think, again, going back to this volatility episode, it tells you that a lot of active managers really, really degrossed. And going into last week's blockbuster earnings, basically the analysis was that exposure to technology, it's sort of a double-edged sword. The reason technology has had a soft 3 months, which is very typical, by the way, happened throughout the 1990s. The NASDAQ drew down by average 19% every year between 96 and 00, so typical. But because technology exposure was reduced, it sort of fed into that. So from our point of view, the active managers, particularly if and I know we'll talk about this in a moment, particularly if there's some more political clarity in a season of record political lack of clarity, that's a positive for the market.
Well, you handled the tease for the next block for us, which is really great. Julian, don't go anywhere. Stick with us. Let's take a look.
Pro.
I know, right? We should have him on more. Let's take a look, though, at what's moving underneath these markets. We're going to do that with Abigail Doolittle.
Well, let's stick with this topic of volatility, Katie, because, of course, the NASDAQ 100 down 1.4%, the S&P 500 down more than 1%. This is very consistent with what we've seen out of September's over the last 5 years, and frankly, going beyond that. But this is seasonality by a month basis over the last 5 years. And you can see that February tends to be a down month, March basically flat, May down ever so slightly. But take a look at September, down 4.2% on average over the last 5 years. So again, the fact that we have stocks down more than 1% today, very fitting to this type of volatility. Let's see what's ahead, especially with this Fed meeting coming up. As for what's happening beneath the surface, Boeing, this is a piece of the volatility, down 7.9%. This, of course, on that downgrade over at Wells Fargo to underweight from equal weight, setting a price target basically 25% below, 20% below this price right now, having to do with the company's free cash flow and the idea that peak free cash flow could be in 2027, a cash opportunity going out the door, that analyst says. As for another laggard, and this is really the big point drag on the S&P 500 and the NASDAQ, take a look at NVIDIA, really a cliff dive today. Over the last 4 days since reporting last week, down 12.2%. Of course, it was a good quarter, but it wasn't good enough relative to the companies into that quarter, greater than 150% increase. Too far, too fast, the AI craze. Now we're moderating, and you can make the case that NVIDIA is going to go back below 100. We'll be taking a look at those technicals not so long from now. Let's end on a bright spot, though, and that is Unity Software, the mid-cap software company, up very nicely today, up nearly 10%. An upgrade from Morgan Stanley to overweight from equal weight. The analyst there really likes their Create unit. It's interesting. There is a 10% bear short interest on this stock, Matt. So the bears, the shorts, are probably also contributing to this gain getting out as, again, Morgan Stanley has upgraded shares to an overweight.
How do you, on the terminal, how do you look up short interest? Do you just do the stock and then SI go?
I do DES, description, and then I look on the little left-hand corner where it says short interest, and that's where I look.
All right. We can talk about it.
Lots of different ways.
Yeah. Bloomberg's Abigail Doolittle, thanks very much for that. Coming up, more with Julian Emanuel of Evercore ISI. We'll look at what the White House race, what could the election mean for markets. This is Bloomberg. Now to high interest, to look at what's making headlines around the world. Airbnb is asking New York City officials to scale back regulation that outlawed most of its short-term rental listings. The company says the law failed to deliver on the promise to combat the housing crisis. Instead, travelers are priced out and hosts are struggling. Meanwhile, Aston Martin's Formula One team is pulling out all the stops to sign veteran engineer Adrian Newey. That's according to its billionaire owner, Lawrence Stroll. Here's what he told Bloomberg.
Adrian and I have been talking not only for months, but actually for years. Adrian is clearly the most talented and gifted individual in Formula One based on his track record and history, in addition to being a hell of a gentleman. So I'd be very excited for Adrian to join our team, as I think every other Formula One team on the grid would feel exactly the same.
Stroll typically gets what he wants, but the Aston Martin F1 team has been struggling in this year's championship. Vice President Kamala Harris is moving $24.5 million down ballot to help candidates in races for the Senate, the House, and state legislatures. Harris's campaign said that she believes the race is about mobilizing the entire country. Harris has raised over $500 million since President Biden withdrew from the race. Katie?
And let's stick with politics now with Julian Emanuel. He is Evercore ISI Chief Equity Strategist. I'm going to go to a line in your notes because you write that every presidential election year since 1936, where the S&P 500 was up by 10% or more through Labor Day, saw further gains by year end, even if September and October were weak. So the S&P 500 up about 18% year to date. Is there any reason to think that this cycle could be different?
The only reason one would think it could be different is if there is a prolonged period of lack of clarity after November the 5th. But I would also say the counter to that is the Fed has its meeting scheduled for November the 7th. So they may be on the case to offset that. But if you go back and you think about it, right, you know, the year 2000 was the record lack of clarity that it didn't get decided by the Supreme Court until December. That having been the case, the economy was already starting to show signs of cracking, and you went into a recession in 2001. And part of the reason you did is because the Fed actually waited to cut rates until January of 2001. That's not going to be the case this time.
I've also seen that in at least the last 11 elections, markets are up 6 months after the vote in November. But, you know, previously an inverted yield curve meant a recession. Previously, a jump of 0.5% in the 3-month moving average of unemployment meant a recession. And a lot of rules have been broken sort of post-COVID crisis. Isn't this the time for this to be different?
Which is why we actually, you know, are as vigilant as we are about the signs that this is a more significant top rather than the September seasonal political uncertainty market pullback that we think it is. And part of that is that, you know, when you get down and you look at the employment data, and this week's data is going to be interesting, it just we're not near that recession zone.
Julian, how uncertain is this political cycle when you see the policies, really a maelstrom of controversial policies taking place in both presidential camps here, or presidential candidates? You have Kamala Harris potentially looking to tax unrealized capital gains. You have Trump's tough on China tariff policies here. At the end of the day, for an investor, what do you have to zero in on of the policies that are being proposed?
Well, what I would say is rather than the specific policies, because there's a lot of bluster, it's the implementation part that's the bigger challenge. Key off of this idea that usually markets actually prefer unified government. You go back over 100 years, it's almost 300 basis points per annum outperformance, unified over divided. That is not likely to be the case this time. I think there is a vast preference.
That's so weird, by the way. That's really a weird stat.
No, but think about it, right, is that because unified governments spend more money.
Huh.
And that's...
To that end, how much should investors be watching congressional races? Because at the end of the day, it's Congress that's going to really make the difference here.
Very, very closely from our point of view. And you know, the fact is that it seems like you could actually flip both the House to Democrats and the Senate to Republicans. And I think if you had that, there would be a comfort, whoever wins the presidency, because some of these further out policies would be much more challenged to be implemented.
Let's talk about how you trade this, because also looking at your notes, you write that QQQ convexity with the VIX in the teens is a must own for either the traditional September sell-off.
What is QQQ convexity?
That's what I'm going to ask. Put that in layman's terms. I'm thinking about the time I brought up the VVIX and Matt just exploded. So what exactly does that mean?
Well, we think you own puts and calls, okay? Because basically, if you look to next week, if there's more clarity coming out of that debate, say the degree of clarity that we saw after the June 27th debate about what the outcome was likely to be, that could actually send markets up, contravening the typical September seasonal weakness. But I will say this, today, really, as much as I like college football and the NFL, why does anyone prefer fall over summer? This happens every September, and for us, this is the way owning option convexity allows you to stay invested through days like this, which could be weeks like this, you know, and be positioned for what we expect to be the typical fourth quarter strength.
Let's talk about timing. Sonali and I were talking to Rebecca Patterson last week, who said that don't put on your election trades until October or until, you know, very, very close to the election, because things could change. When it comes to this convexity call, is this a right now trade?
It is a right now. It's actually been for the last several months, but now, I mean, think about it. We were at 65 in the VIX in August, and now we're back in the teens. There's a lot of value there.
All right, Julian, always great to have you on. Hope you'll come back soon. That, of course, is Julian Emanuel. He is Evercore ISI Chief Equity Strategist, and this is Bloomberg. All right, let's get a check on these markets about an hour into the U.S. cash session, and it's just not that good looking. You take a look at the S&P 500 down 1.2%. Of course, volume coming back in full force. You think about everyone returning from the Hamptons and wherever else they were over the Labor Day weekend. You take a look at big tech. That's your big loser on the day. The NASDAQ 100 down 1.6% at the moment. Again, we got a rally to end last week on Friday to end the trading month of August, but you're seeing that absolutely dissolve right now. If you're looking for good news, it's that actually the bond market is hedging your losses right now with 10-year yields down 6 basis points. Matt, that is a rally as the price moves inversely.
If you were coming back from someplace further away than the Hamptons,
such as,
and looking to end up in New Jersey,
right,
you might not be back yet. Coming up, we're going to take a look at the travel outlook for the rest of the year. Big delays continue at Newark. We'll speak to Brian Kelly, the Points Guy founder, next. This is Bloomberg. Trouble at Newark Airport. A radar issue at the airport delaying airliners yesterday. For 30 airliners were delayed. Sorry, the outage caused problems for Labor Day travelers, definitely in America, maybe around the world. For more on the travel industry, Brian Kelly, the Points Guy founder, is with us. The Points Guy helps millions of people around the world travel smarter. I know we use it at home to try and figure out when to exchange Amex points for whatever airline. But in general, Brian, you've become an expert across, the air travel industry. These snags that we see, yesterday in Newark aren't anything compared to what we've seen on other big travel weekends. They seem to get worse and worse, like global warming. What's the problem just in general with airlines these days?
Well, I mean, we desperately need an infrastructure overhaul. With the big government infrastructure bill that was passed by the Biden administration, there definitely have been improvements, but air traffic control specifically, our air traffic control network in the United States is incredibly outdated. And in general, the technology that underpins most of the aviation and the government, the ATC side of things is very old. And we're seeing a simple vendor like CrowdStrike can cripple the entire industry. We've had air traffic control 2 summers ago. The FAA, someone uploaded a wrong file and shut down all air travel for hours. So the system's fragile, and as more and more people are traveling, I anticipate more of these snags. So as a traveler, you need to know how to manage them when they do inevitably happen.
So I've noticed lately that flights are all full, but I thought there was a little bit of overcapacity, which has led to weakness in airline stocks over the summer. Where are we in terms of capacity? I mean, do they have enough planes? Do they have enough seats in the air, or do they have too many seats that are empty in the air?
It's an interesting dynamic. So domestically, there's too much capacity. The low-cost carriers are really, really struggling. JetBlue just posted a surprise profit, but the way they're getting there is by cutting back on new plane purchases. And boy, a lot of their planes, they need a refreshing. So the downside to cutting back on new planes means more maintenance delays down the line. So they may have profitability, but their flyers are going to have more maintenance delays. So the whole industry is really, the Middle Eastern carriers are making a big profit, but it's tough out there, especially domestically. Fares are down 19% from 2019. So it actually is a good time for travelers.
Well, Brian, but to stick with the sort of perspective of the airliners for a minute here. We heard from Ryanair's CEO last week at a press conference in London saying that those Boeing delivery delays are costing it millions of ticket sales. I feel like the Ryanair CEO has been particularly vocal when it comes to the impact, the ripple effects of what we're seeing going on with Boeing. But
he has to be the most vocal airline CEO in world history.
Yeah, exactly. But to that point, I mean, would you expect to see more of these types of headlines from other airlines if we continue to see these delays, which seems like that's the base case here?
Yeah, I mean, the U.S. carriers are no different. United Airlines has vocally said, come on, Boeing. Like, I think that was a big impetus behind Boeing finally getting a new CEO. Their customers are at their wits' end. And it's pretty much most of the planes Boeing is supposed to deliver are way delayed. That's causing airlines to lose on profitability because jet fuel, even though it's not completely spiking and it's at reasonable levels, you know, these old planes are gas guzzlers. So all of these profit models the airlines have banked their 2020s growth on are not coming to fruition because they can't add new routes. They can't get those gains in sustainability and increased productivity from these new planes. So yeah, it is a big issue. And I'll also just call out the pilot shortage is another issue that we're going to be seeing more and more of. There simply aren't enough pilots out there, and that's going to become more of an issue, causing more delays for the aviation sector. There are a lot of road bumps to come.
So a lot of strain from the perspective of the airlines. But I mean, how does this filter through to the end customer of tickets when it comes to airfares? Because you talk, of course, about the delays, you talk about the pilot shortage, of course, and at the same time, you have a lot of flyers saying that ticket prices are just too high. But if you have profitability being eroded here for the airlines, what levers do they have to pull?
Well, I mean, for consumers, you know, where consumers are really being hit are on fees. So most major airlines have now raised baggage fees. So while airfare has come down compared to last year, compared to pre-pandemic, consumers are getting hit. And also when these huge outages happen, you know, we don't have a passenger bill of rights in the US like they do in Europe. So the CrowdStrike outage, for example, millions, you know, not millions, but a lot of travelers had to eat the cost of getting to their final destination, buying other tickets. Delta has said that they'll, you know, try to reimburse people, but the consumer's getting hit in a lot of different directions. So even though fares, you know, it's a relatively okay story for the consumer, there's a lot of road bumps and other costs that they're, being hit with.
We really have to recognize not only are consumers constrained in many ways, so are workers. And you see it by the thousands of people across the hotel industry and the airline industry that are already striking or are planning to soon start striking over pay and other working conditions as well. Ultimately, when you look into the year even further, how might this start to impact the travel industry at this point in time and the ability to travel comfortably?
Well, I think this goes hand in hand with what I was just saying is, you know, especially in hotels, consumers are paying more. So while airfare has stabilized, hotel rates are up and consumers are not getting the same level of service. You know, the hotel industry, I think they've got their hand caught in the cookie jar a little bit. They've rolled back perks, they've rolled back housekeeping, they've gotten consumers paying more for receiving less. And these striking workers today are saying, hey, look, the burden is coming down on us. It's the housekeepers, the chefs, the front office staff. We want more of a share of all of these increase in profits. And, you know, it's only 24 hotels striking this weekend, 10,000 or so employees, but Unite here has 250,000 employees, and they've said that they're willing to start striking across the country. So this could become a recurring theme if these labor disputes aren't solved quickly.
Brian, you kind of highlighted here a multitude of issues when it comes to traveling through the rest of the season. Are you seeing consumers start to make different choices, staycationing perhaps, or doing more things on a local basis, traveling by train, for example?
Absolutely. We've seen a huge increase, especially because gas prices are down from last year. And I think a lot of people who've got stuck in airports, you get stuck once in the airport with kids crying, you're not getting information from the airlines, you will swear you're going to road trip or take that train trip next time. The Pacific Northwest, my parents are in Alaska right now. They did a beautiful train trip. They have had the best time, no flight delays. So I do think that all of these disruptions in air travel, but by and large, consumers are still flying. We had almost 3 million passengers this past Friday. We hit the 3 million daily TSA passengers for 4th of July. So the skies are going to continue to be really crowded. And one final note for passengers out there, there aren't a Bill of Rights for you in the US. You can try to go to your airline to get compensation, but people need to go to their credit card company. So many of these premium travel credit cards you're using, the Amex Platinum, Chase Sapphire Reserves, they come with trip delay and cancellation and missing bag coverage. So when the airlines mess up, which they will, always make sure you go to your credit card and see what perks you have there to help you make good when you're out of pocket.
Yeah, that's one of the advantages of being a European citizen. You have a Bill of Rights there. I'm not sure that our Congress is going to deliver that to Americans. Brian, who has the best points deals right now? Because I've seen a real inflation. My wife told me yesterday we had 230,000 points, and I thought, oh, great, that's 2 business class tickets to Europe. But it's not anymore, not by a long shot. Where can you get the best deal on points?
The best deal on points is with foreign frequent flyer programs. So, United, Delta, American, they all have what's called dynamic pricing, meaning you never know how much it's going to cost. And often it's over 200,000 miles just for one-way business class ticket. Consumers need to transfer those Amex, Chase, Capital One points to programs like Air France Flying Blue, where I flew 50,000 miles business class one way. The same flight on Delta was 300,000. So the huge value, Air France, Air Canada, they're all transfer partners of the big US credit card companies. And there are sites like point.me that will actually help you determine where there's availability and which of those credit card transfer partners you should actually transfer your points to.
And Brian, before we let you go, I do want to talk about this concept of over-tourism and the protests that you saw break out specifically in Barcelona in July. I know that, Matt, you just got back from Spain, for example.
But Venice has bad over-tourism. Prague has insane over-tourism.
Exactly.
Yeah.
So, I mean, I'll toss the question to you. I mean, do you think that when you think of some of these popular destinations overseas for Americans, are they getting a little less friendly to tourists? What's your thinking there?
Absolutely. And I encourage people, don't go to destinations where the locals are saying, please don't come here. Or if you really want to go to Barcelona, go in November. Off peak, it's going to be nicer anyway. Remember, Europeans don't love air conditioning like we do. So all these Americans who go to these blazing hot Euro hotspots, it's hot, it's crowded, expensive. So
and there's no ice, at least in Europe.
Yeah. So, I mean, the shoulder season now is, Europe is busy all throughout the fall. But yeah, go to different destinations, spread those tourism dollars around into more rural areas and bed and breakfasts, stay less at the big chains, and spread that tourism dollars to the actual local community so they actually get reimbursed for the annoyance of having tourists in their town.
Matt is looking at me, just nodding, don't go. But I like to think that's because he wants me right here next to him. Yeah. Brian, thank you so much. That is Brian Kelly, the founder of The Points Guy. Of course, a very complicated travel market out there and a lot of movement in the airline stocks. But we're going to get a look at the markets. Otherwise, we have Bloomberg's Abigail Doolittle.
We're looking at the worst day for stocks in about a month, Sonali. Take a look at the S&P 500 near session lows down 1.4% almost. The NASDAQ 100 down the better part of 2%. The stocks, though, really getting hit, down more than 5%. And a big culprit, of course, is NVIDIA. Over the last 4 days, down more than 12%. Today, down 6.9%. Those 4 days, the worst going back to 2022. This, of course, after the quarter that they reported that was good. They guided better, but not the blowout that they've done quarter after quarter. So some of that hot air coming out around the AI craze. In fact, let's put this into the context of one of the charts, the technical charts, because this is interesting. This is another one that's not so aesthetically attractive, but it's got an important message, which basically is we are looking at a range, the top of the range, let's call it 130, 140, the bottom of the range, closer to 90. The move down, we gapped today below that 50-day moving average onto the 100-day moving average. It's very likely that we're going to go sub 100 again. The importance of the range, though, is not so much the range itself. It's which way will it break out. There's another way to draw it that makes it look like a quote-unquote double top, which if that's the case, we could see NVIDIA go much lower. Let's get down to the bottom of the range first, though, to determine whether or not that's possible. But it's not just NVIDIA that's pressured. We have a lot of pressure on markets, and I would say a lot of it has to do with the yen. It's not unclear that the unwind of the yen carry trade is over. If you take a look at those charts, which we don't have here, but it does look like the dollar-yen could go significantly lower, down toward 130. If that's the case, that cheap fuel, cheap money coming out of the system unlikely to be matched that quickly by the Fed's cutting. That could put pressure right across the board. Today we're seeing it on oil, also the energy sector. That's the worst. Apache down 5.2%. So we have weakness right across the board here, Katie, for risk assets. September starting off in usual fashion, typically over the last 5 years, down on average more than 4%.
All right, Abigail Doolittle, really appreciate that roundup there. And coming up, question marks around some of the AI high flyers. Wall Street starting to short some of those names. We're going to take a look at the winners and losers next. This is Bloomberg.
Welcome back to Bloomberg Open Interest. Let's get a check here on the markets because you do have a down day. It's getting pretty ugly out there, actually. You are near session lows of the day with the S&P 500 down 1.4% now and the NASDAQ 100 down more than 2%. A drop in the 10-year yield by about 7 basis points here to 383 after that ISM data came in weaker than expected. And you are having the worst day in equities in at least a month. And remember, August was really choppy, but September could shake out to be choppy as well, Katie.
Yeah, it's certainly ugly out there and getting uglier, which brings me neatly to short sellers who are taking a closer look at the AI mania. Check out Supermicro, Lumen, and Symbiotic. They were hit by bearish research reports questioning their valuations. You can see that the shares are getting punished. Bloomberg's Bailey Lipschultz has been all over this. And Bailey, I'd actually like to just set the scene here and zoom out because there are a lot of people sort of writing the obituary for the short selling industry. Earlier this year, you had Jim Chano say that he wasn't going to be seeking new money. You had Carson Block launching a long-only fund, which felt like a sign of the times. But now it feels like there's been a bit of a pickup, a bit of a revival when it comes to short selling campaigns.
Certainly, Katie, and they're really focusing on AI stories, which we write about in the story. But the big thing with these activist shorts typically is that they're betting against companies that they're finding flaws in their views with business models or with promises. And that's why when you look at the group of companies that have been targeted in the last 2 weeks, the thing that's interesting to me is they're all different stories. So it's not simply a valuation argument, which is where a lot of the short sellers kind of were dealt the wrath of retail investors. When you look back at GameStop, they weren't saying GameStop did anything nefarious, but they thought they were overvalued even though they were trading at $4. And when you're a short seller,
because they sell video games in brick and mortar locations when everyone downloads video games over Wi-Fi. Like,
but at the same kind of take, though, Matt, is if you're going to short a stock to zero, your risk is infinite to the upside, and that's something that hit Andrew Left, hit Melvin Capital. When you're betting, you can technically, as John Maynard Keynes would say, markets can be remain irrational longer than you can remain solvent. That's something that happens. I had to pull that up so I didn't misquote it.
Well, let's wrap this together because you're talking about Andrew Left. You're talking, of course, about the idea of shorting to zero. It feels like the Andrew Left just debacle caused a bit of a chill in the short selling industry. And you saw Carisdale come out with a short report against Lumen, for example, but the disclaimer was so sarcastic, almost saying basically don't assume that we're still in this stock once this short report actually gets published.
Yeah, and Sam Carisdale is a snarky guy, so he definitely leaned into that with the tweet. But the big thing is this is trying to just protect themselves because there's so much unknown about what that Department of Justice probe could mean, and trying to at least cover their liabilities, cover any legal kind of rulings that could happen, where if you're blasting a company and you are profiting on their stock price falling, you at least need to disclaim to readers that that's what you're doing, which is kind of common sense, but that's what's happening.
Very curious about how long these short positions can really last for. You take Supermicro, very much an AI darling for so long. Last week took an absolute bath after that Hindenburg report and then saying that it would delay its 10K filing. Shares are actually up today while the broader market is down because they told their customers and partners that they have strong confidence in their teams. They finally went out and said the short seller report contains false or inaccurate statements. So were most of the gains, so-called gains, in that short kind of already had after that initial report?
We don't know, and we don't know what Nate Anderson's doing, and we don't know because a lot of the short interest data is delayed typically by about 2 weeks when these short bets are covered. But Sonali, the one thing that does stand out when you look at that report and you look at some of kind of the critiques around a Supermicro, company went from less than $2 billion in market cap to north of $65 billion in just a few years. So some of these kind of reports some of the different kind of factors that companies that are in the S&P 500 are well-known names. If you grow that quickly and escalate that quickly, management teams kind of have to rein in some of their controls, and that really was what stood out from the Nate Anderson short report.
I wonder what your reporting reveals about congressional concerns on shorts in the U.S. Obviously, in communist countries or authoritarian regimes, populist countries, they come down hard on shorts, especially when the market's down. But here, in a thriving free market democracy, where short sellers are a really important part of market price discovery, do we have Washington still trying to clamp down on short sellers?
I think when you look at the Andrew Leff case, and again, there are a number of things going on with that, but when I talk to short investors and when I talk to some of these advisors, they look at and say shorts deserve to exist in a market. To your point, in a free market, short sellers.
Bailey, should the disclosure rules change? To the point you just made 2 seconds ago, you get a 2-week delay on whether they close the short, but an immediate reaction when they report the short.
So should disclosure rules be the same for long investors?
Well, if you file a 13F and take an activist stake, you have to file much more swiftly, don't you?
Well, you have to keep people in the know of what you're investing, but there are other ways to kind of hide those bets. Like a number of these investors, to Matt's point, are likely uncovering issues, and they're also showing some of the bad actions that could be happening. There are a number of historic short sellers who called out the likes of an Enron, which deserve to be out there. But to your point, if you're what is kind of phrased as a smash and grab, which is shorting a company, putting out some kind of inflammatory report and immediately covering, the conversation around market manipulation gets a little bit tougher.
But also, I mean, does that happen even nearly as much as a fraction of the amount that happens in a pump and dump?
It was happening for years with Andrew Leff.
Yeah, but that's one person, right?
How
and
many
people
are
have been
there that we
talking their
follow?
book on long stocks and then selling as soon as the market goes up forever.
Okay, we're going to have to have Bailey back. This is clearly a conversation on this desk. Katie.
All right, our thanks, of course, to Bloomberg's Bailey Lipschultz. Now, coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg. All right, let's get you to the trading diary. What you need to be watching next week. Tomorrow, of course, it's still earnings season, so we get Dick's Sporting Goods, Dollar Tree, and Couch Chart. We also get Jolts and the Fed Facebook. And then on Thursday, more earnings, this time from Broadcom, of course, closely watching that one. And then on Friday, it's the big dance. We were talking about the U.S. jobs report. You think about the focus of the Fed and participants in this market, it has really shifted from watching every single scrap of inflation data to now watching every piece of information we can get on the labor market.
Yeah, and I think, you know what, if you look at markets, it makes sense that you sell today, right? Because if you expect the labor market data to be better than it is, forecast, then there's less of a chance of a 50 basis point cut, right? So you don't just go and buy thinking that jolts and jobless claims are being better than expected, because if they are, then the Fed cuts less, and it still hurts you.
You think about the Mike Wilson note over the weekend from Morgan Stanley. 50 is both good and bad, isn't it? A 50 basis point cut might ease pressures on the financial markets. However, it also sends a signal that things are worse than expected, and perhaps 50 is not even enough to ease those pains that we've been talking about.
Yeah, and I do like that point from Tracie McMillion. I mean, going back to our 9:30 conversation, that we're splitting hairs here. 25 or 50, we know what the path is. We know that this Fed is going to cut rates several times. Don't get too hung up.
Doesn't get people into mortgages, doesn't get people into cars right away.
It's very true. I mean, if you want people to buy houses, if you want people to buy cars, you need to cut much more.
But stick with us through tomorrow, of course, and through the trade. Tomorrow, we're going to talk to the CEO of Raymond James. That does it for Open Interest. And this is Bloomberg.